Hey everybody, hello and welcome to the Market Movement Intro Series. The aim of this series is to help folks understand the basics of auction theory and how the markets actually flow and move. Knowing what generates price action and how to read it will ultimately help you become a better trader by being able to take only the best setups for your strategies, as well as keeping tight control over the risk to reward of your trades. Think of the market as a flow of capital, as an auction process takes place. As capital flows in, the price rises, heralding demand for the auction. Once the flow of capital shuts off and value is established, that flow then ebbs around a zone, expanding sideways. When value changes again and capital begins to flow out, price then falls, exposing an abundance of supply. This dance is the sequence and cycles of market activity. It is referred to as distribution and balance, or, in other words, trending and bracketing. So what we have here is a daily chart for the ES. This is a 3-month chart, my preferred chart to look at when I'm trying to get a longer, more broader outline of what current market activity is. But I want to show you a little bit of what I was just talking about. So the market's price, it's going to ebb and it's going to flow. And if we kind of follow it, we can see it doing this very snake-like pattern: highs, lows, dippity-doo-dahs, zippity-days, and all that fun stuff. So what we're actually seeing though here is we're seeing price trend towards a value, finding that value, balancing out sideways, determining value is no longer in this area, testing it, then proceeding to break and flow, finding more value, break, flow, find value, break, flow, rinse, repeat. So this is a way you can see this a little bit more visually. A market's price trends when longer time frame traders see an advantageous price to perceived value. And they either sell the supply, which drives the price down to the new perceived value area, or they buy up the supply, which drives price up. This trending behavior continues until price reaches the perceived value. Other time frame traders view the new price as advantageous to the other direction, and an opposite push of capital occurs. This causes price to begin moving sideways, in balance, as traders trade around the perceived zone of value, testing the highs and lows until the next cycle begins with a new perception of value driven by a trend reversal or a trend continuation. These cycles don't just take place on larger time frames. They're actually going to be taking place at all the different time frames in the market. So on our daily here, we can see our trend bracket, trend bracket, trend bracket, trend bracket, etc. But if we break this down a little bit further and we go and look at our 5-day, 15-minute chart, we're going to see the same thing. There's areas in which the market brackets, establishes a low, establishes a high, tests that high, tests that low, and then ultimately decides to move in a direction to a new perceived area of value. And then we have another bracket. We test the lows, we test the highs, we break out of the bracket, we confirm, and we start a new trend. Bracket, break, confirm, continue. Bracket, test, break, reverse, bracket, break, continue, bracket, break, continue. So we can see here that over the course of 5 days in this particular market, we had an established bracket to start that then broke down looking for new value. What happened though is that there was no new value to be found below this point. So when we inevitably broke back up, the trend continued on. It tried to test a little bit lower, making sure that there was no more business to happen. This particular event, This was the FOMC meeting from last Wednesday, where they finally announced the rate hike that they've been talking about forever. And what you see here is a rather violent reaction in which the longer term timeframes are trying to establish where the value is. And we can see as they pushed it down, we never ended up breaking this previous zone, this previous bracket. Again, this is just on the 15-minute, but to illustrate the point, because there still was no value down there, we had an opposite reaction to this aggressive price that then moved us back up to find a new zone, a new bracket. Oftentimes what you're going to find with this type of price movement is that our value zones, as they move from trend to trend, they do tend to overlap each other just a little bit. Now, what ends up happening when you have a really big gap between value zones, that is always significant. That's something we want to bring further ahead into our charts. That's actually why I've got this marked out here, because I wanted to make sure you guys knew that, and you could see that that was important. So let's kind of break this down a little bit. Right as we started into our January of 2022, we can see that we started a trend down, found balance, and then we had a very aggressive gap down. Well, this gap was so aggressive that it left so much space for the market to think about whether or not value was where it was supposed to be. So we had an opposite reaction in which we trended back up. Value could only be established up to this point before breaking down again. We can see that we had tests of the low, tests of the high, and ultimately that break back down. But we still have this little gap to be paying attention to, especially now that we see the market starting to trend back up. Now, this isn't me saying you should get into a long position here, because we're going to obviously trend back up to this area. What I'm saying is that there is a good chance that the next bracket we find is the stopping point before we do move to this next area. Now, of course, we could see some down, we could see some up. The market is never going to be able to be something that you can guess. That's just not how it goes. We have to play with the information that we have. But we know now that we are, in fact, in a trending market. So the idea is we're looking for that next area. We're looking for that next bracket. So if you've already missed this trend, jumping into it now, you're playing a very dangerous game. I mean, look how long some of these other trend areas lasted. 4 or 5 days. I think the longest one we had was here. 1, 2, 3, 4, 5, 6. This was a 6-day trend before we entered into this kind of weird bracket here. So the others, what? We've got 1 between here, 2 between here, 3, 4, 5, I guess. But yeah, so you always want to be aware of what's happening here. Now, why is this information important? Why should we care whether or not we can identify whether a market is bracketing or trending? Well, knowing whether the market you're currently trying to trade is trending or bracketing, it will help you decide where your ideal entries and exits are based on a very tight risk to reward ratio. Trending markets and bracketing markets, they need to be played differently depending on the time frame that you're trading in. So let's look at some examples. Let's talk about a day trade, okay? So let's say we're in our 15-minute here on our 5-day. So let's go back to our 15-minute brackets and trends. And let's look what was going on in Tuesday into Wednesday, okay? So we know that we were able to, before Tuesday even started, we were able to identify that there was, in fact, a bracket occurring. So for a moment, we're just going to pretend that we only have this information coming up to here. We can see that the market's trading in a bracket. So we know that we want to be paying attention to where these highs and these lows are. But as we're getting closer into Tuesday, now this is a 24-hour market, so the thing we need to remember is that Tuesday didn't actually start until right about here. So let's go ahead and add a little arrow just so that way we can see where that candle is. Okay, so that's where our Tuesday market actually opened. So we're waiting, we're watching this information develop. We see that the bracket has now broken. We see that there was an obvious test lower, really, really tried hard because it made a lower low and then another lower low, but ultimately couldn't push and was forced back into the bracket. We see a test of the high, rejection, a break of the high, and look what happens right at this 9:30 candle Tuesday morning. The low touches that bracket zone and doesn't break. And from there on, we enter into our trend to our next bracket, which started at about 3 o'clock, 3 p.m. Eastern Standard Time. So let's say we were just playing a day trade here and we were only using that information that we had. We see that it opens up, it's broken out of the bracket, it's come back down and it's tested the bracket. We could take a long position for a day trade right where that test occurred. If it pushes back down into the bracket, we know that the market's not done testing the extremes yet. We get out of that trade, we take a very small loss. If the bracket holds and we instead are actually entering into the first part of the next trend, well, guess what? We just got the absolute perfect entry for a long position. And we can proceed to ride that out all day, even at this part where it pulls back. Because our entry was down here, we're still in a very safe position where we can let price action continue to play out. We could also, of course, move a protective stop up with that as price action occurred, and then we probably would have gotten kicked out on this pullback, but that's still a good winning day trade play. Or we could have let it keep running, and then right about here at 4 o'clock, well, we can see that price did run up again for an even nicer win. But that's just a little example of something that you could take from this for day trades and what you're looking for why identifying bracketing and trending markets can help you pick your ideal location and entry for the day ahead, for the plays that are coming. Just to break that down a little bit further, again, looking at the information that we had, there was no way for us to know that Tuesday was going to trend. But we know that once a bracket breaks, and it's retested, if that holds, there's a good chance that we are on a new trend. And then the same thing, if it ended up breaking back into it, there's a good chance that we weren't. So let's look at this failed attempt right down here, right? It breaks through. If we had played this break thinking, oh, okay, we're getting into that new trend, well, we would have come back up and, this would have been a really terrifying position to hold. Now, what could have given us some hope was then watching it come back down and drop to another new low. But again, still watching that, it ends up coming back up. So just for the sake of argument, let's say once this broke through and came back down, we did decide to play that trade. Well, in the day trade sense, this still isn't a terrible play, right? We have pretty good trade location. We know we're wrong if it breaks back up here. We watch the price drop a couple of candles and then turn back. This is a trade that we can get out of with a small bit of profit before it ultimately turns back around. Without that trend continuing on, we can see that we're starting to make high or low here, and that's just not something you want to get wrapped up in. But once it breaks back into the bracket, because we had that failed break below, oftentimes a market is going to test the opposite side on a failed break. It did test on the failed break, retested to make sure the break was okay. So remember, we have a break, test, it failed the test. It did come back in, even though that's just a wick, ultimately leading to a break, test, trend. So where we want to look at from here, we just kind of talked about risk reward and identifying where the most advantageous spot is going to be for your particular trade. So that's for our bracket. But let's now look at an example of playing. Oh, I'm sorry. I actually got ahead of myself. So we just talked about an example of playing the break of a bracket into the trend. That was a really good trend play. But now, if let's say we were playing a bracket, what we can't do is we can't make those position plays looking for the run to keep going and occur. We have to be a little bit more careful. We have to be a little bit more strategic. So let's look back here at this bracket section. One of the things that we could do watching this bracket develop, so again, we're going to pretend we only have as much information as we do moving up. The market trended, it came down and it established a low. then came up and it established a high. So at this point now, we do have sideways action in which a bracket is occurring. So anything after this point, we can make a better strategic decision about, because we would have all of this as information. Now we know that it's bracketing. So if we're going to try and play the bracket, what we're going to be looking for is we're going to be looking for failures to execute outside of this bracket that we can play to the opposite side, moving back to where the median price or the middle is. So if we just kind of extend this out as it went through, we get the top of our bracket established. We watch price action come back down, come back up. We see it fail to break out of the bracket. We see it struggle right here. That's our flag to take our short position play. And sure enough, we could have taken this short position and we could have taken profit right here at the mean, right here at the median price, right where it runs through the middle of everything. Now, we don't have to take our profit there. There is always the chance that we are going to move to the opposite side of the bracket and test the low because we test the high. But when you're playing the bracket, it's always safest to take your profits at the median. Just looking at this example a little bit earlier, after it tested its high and it came back to the median, well, it went back and tested the high again, right? Markets are unpredictable. They're going to do things like that. So knowing where your highest percentages are, knowing where your highest chance is, that's going to help you maximize your profits in different market conditions. So we play this position, we take our profit at the median, and we wait for the rest of the play to develop. Sure enough, it does in fact drop through. Okay, boo-hoo, we missed out on some profits. Well, here's the thing though. We missed out on those profits, but then we got to watch everything else develop to playing the trend on the following day. All right? Now, these are just two small examples. And you're not going to be able to spot these zones immediately. This takes a lot of time. It takes a lot of practice. Watching a chart that's frozen, I mean, obviously we could be hindsight millionaires here because we have all the information. Sorry, oh yeah, I could have played here. I could have played here. When we're doing this, we have to take into consideration, we have to try to always remember, we don't have all of the information. So that's why when I was explaining these plays to you, I tried to take it a step further back to really look at just what we had when those plays were developing. So you can still see out that, yeah, I can see the whole chart, and I know that entering here was a great idea, but I can also explain to you why it still would have been a good idea even without having the rest of the chart shown to us. So what I want you guys to do is I want you to pick out your favorite tickers that you like to watch, and I want you to go back and I want you to identify those bracket zones. I want you to identify those trend zones. I want you to pick out where your advantage spots would be for taking your risk to reward ratios. Practicing it on a chart that isn't moving is going to give your brain more time to pick up on these patterns. Because ultimately what we're trying to do is we want to be able to see this before we can see that. And what I mean by that is wrong tool. Let's just do this. I want you to be able to see this on your chart, see that break away from this zone, the comeback and the test, and I want you to be able to confidently take a long position on a candle like this. Again, we don't have the rest of the information. All we know is a break occurred and it tested its support. But we can then play it out, right? Now again, this is going to take practice, so you've got to work on it. You have to be open to being able to see these things, and you have to recognize that you have to give your brain permission to put these puzzle pieces together and to see the picture before it occurs. But you also have to be prepared that if it didn't play out like this, if you did get in on this candle and then the next candle breaks back into this bracket, you exit the play. Because what your brain was seeing, the pattern you were playing to, it's not there anymore. It doesn't exist. There's always going to be another play down the road. We don't need to hold and hope onto positions. We need to take advantaged choice entries where we know if the pattern is continuing or if it isn't, and we know where we're in and where we're out. All right, guys, I really hope you enjoyed this video today. I hope you learned some stuff that you can take into your trading for next week and forever down the road. And I hope you guys go on and you practice some of this. As always, please, if you like this video, feel free to give us a like, subscribe. You'll be notified every time we get some new content coming out. And of course, you can always join our Discord community where we talk about this stuff every single day. And you can ask me questions in live time. I'm in the Trader Chatter every morning, and I'm always more than willing to help people out. We were all there, and we're all trying to get further on this journey. All right, guys, take it easy.